Turn on the news this week, and you'll hear two headlines. Nvidia's growth is slowing. Maybe the AI boom has peaked. And Alibaba says it has a new AI chip. Maybe Nvidia's dominance is under threat. But both of those takes miss the bigger story. Because the real risk isn't Nvidia losing sales. It's the trillions of dollars of credit underwriting the global AI boom. Today on Global Notes, I'll take you past the headlines, into the plumbing of the financial system, and show you why the real bubble isn't about chips, it's about debt. For 2 years, Nvidia has been the heartbeat of AI. Its chips powered every model, every data center build-out. But now, growth is flattening. Wall Street wanted $60 billion in sales, Nvidia guided to $54 billion. Still massive, but the first sign momentum is slowing. Here's why that matters. Nvidia says the opportunity is $3 to $4 trillion by the end of the decade. But the debt to fund that opportunity? It's already here today. Long-term loans are being issued before the profits exist. Technology cycles are short. Credit cycles are long. That mismatch is the first crack in the story. At the same time, Alibaba's stock jumped. Not because shopping demand is booming, revenue actually missed forecasts, but because investors think Alibaba has built a new AI chip to replace Nvidia in China. Experts agree China is still behind. But geopolitics leaves Beijing no choice. US export bans block Nvidia's top processors. So Alibaba, Huawei, Baidu, they're all spending billions to build domestic chips. And just like in the US, that spending is fueled by credit. Only in China, it's state banks and government funds leading the charge. In both systems, the pattern is the same. Money is deployed first, profitability can wait. This is the part almost no one covers. The AI boom is no longer just funded by stock markets. It's funded by credit. In the US, private lenders are pushing about $50 billion a quarter into AI projects. Bonds tied to data centers are up 30% this year. Utilities are borrowing heavily to build out new power capacity. In China, government lending and investment funds are pouring capital into chip makers and cloud platforms, often for strategic reasons more than commercial logic. On both sides of the Pacific, the fire hose of money is flowing, long before the revenues are proven. We've seen this before. In the early 2000s, telecom companies borrowed heavily to lay fiber optic cables, far more than demand could absorb. In 2008, subprime mortgages were packaged into safe-looking debt that collapsed when reality caught up. Even in the shale boom of the 2010s, easy credit built huge supply, investors lost money, and consumers saw cheaper prices. Today, credit is building AI campuses, chip factories, and power grids, with cash flows that may take years to materialize. The rhyme is clear. Credit has sprinted ahead of reality. If growth slows further, who pays? In the US, private lenders and bondholders take the first hit. But here's the part most people don't realize. Retirement accounts could be next. The Trump administration has floated the idea of steering 401ks into private assets. Exactly the kind of opaque credit being used to fund AI today. That means ordinary workers could end up holding this risk without ever knowing it. Then come the utilities. If their massive grid upgrades don't pay off, the costs are passed on through regulated rate hikes, straight onto household power bills. And in China, the backstop is state banks and ultimately taxpayers, who would cover the losses from politically driven chip projects. No matter where you look, the burden doesn't stay on Wall Street or in Beijing. It flows down to pensions, to utility bills, to ordinary families. So yes, Nvidia's growth is slowing, and yes, Alibaba wants to replace Nvidia in China. But the real story isn't who wins the chip war. It's that the entire AI boom is being built on credit. Credit that is long-dated, opaque, and growing far faster than proven profits. The question isn't whether AI will change the world. It will. The question is, who pays if the credit bubble bursts first? If you found this video useful, please comment, like, share, and subscribe. It helps more people discover Global Notes and the unique macro stories that mainstream media misses.